Welcome to The Explainer. Today we're diving into something that literally affects almost every single person on the planet, yet the actual mechanics of it are completely hidden from view. I want you to think of the multi-trillion-dollar global insurance industry as this massive, humming economic engine. Now, for decades, this engine ran perfectly on a very specific type of fuel. But recently, well, due to some massive macroeconomic shifts, that engine basically broke down. So we're going to look at exactly how the top minds in the financial world are frantically trying to rebuild it right now from the inside out.
Okay, let's dive into this. Here is our roadmap for today. First, the insurance profit engine. 2, the low rate crisis. 3, the widening profitability gap. 4, the search for yield. And finally, number 5, optimizing capital efficiency.
All right, starting with Section 1, the insurance profit engine, the blueprint.
So the absolute lifeblood of the entire insurance industry is a concept called float. Think about it. When you pay your auto or home or life insurance premium, the company doesn't just shove those dollars into a vault to wait around for an accident. Because they collect your premium payments up front but don't actually pay out claims until much later, they end up holding this vast, incredibly massive pool of available money. That is the float. And this float is the true fuel of the insurance engine because insurers take that capital and invest it. That's where they generate the bulk of their actual profits.
It really all comes down to the time value of money. Step 1, you collect the premiums up front. Step 2, you invest that float to generate a yield. And Step 3, you pay out the claims later. For what the industry calls long-tail lines, stuff like medical malpractice or general liability, this money can just sit on an insurer's balance sheet earning interest for, 3 to 4 years on average before a claim is finally settled. In life insurance, it can sit there for over a decade. Now, what actually happens to those profits depends entirely on the structure of the company. As the Insurance Information Institute points out, you've got 2 main types. Stock companies are accountable to shareholders. They can raise capital easily and they distribute dividends to outside investors. Mutual companies, on the flip side, well, they're actually owned by the policyholders themselves. So their profits are generally retained to benefit the members, usually through lower premiums or dividends, really prioritizing that long-term stability. But honestly, regardless of whether they're a stock or a mutual company, they both absolutely rely on that critical step 2, investing the float for yield. Which brings us to Section 2. The low-rate crisis, the wrench in the machine.
$16 trillion. Just let that enormous number sink in for a second. In the wake of the global financial crisis, and then heavily accelerated by all the monetary stimulus during the COVID-19 pandemic, central banks pushed interest rates structurally lower. They pushed them so low that, according to Swiss Re data, we actually hit a point where there was $16 trillion of global public and corporate debt where the yields were negative, meaning investors were literally paying for the privilege of holding that debt. It's wild.
And this brilliantly illustrates exactly what that explosion looked like. Notice how negative yielding debt just skyrocketed. At one point, roughly 25% of all global bonds were trading with negative yields. For an insurance industry that historically parked its vast float in safe public government and corporate bonds just to earn a nice, reliable 4 to 6% return, this was an absolute disaster. The reliable fuel source for their profit engine had simply evaporated.
Let's look at the fallout in Section 3, the widening profitability gap, the squeeze. Check out this 100-year inverse correlation. The light blue line is government bond yields, and the dark blue line is the combined ratio, which is simply a metric of underwriting profitability where, remember, a lower number is better. Over the last century, there's a striking 70% inverse correlation here. It's like a seesaw. When bond yields drop, insurers can't rely on investment income anymore, so they have to dramatically improve their underwriting results to compensate. That means charging higher premiums and being way stricter about claims. But in a highly competitive market, just hiking up prices isn't exactly easy. So this created a severe profitability gap. Property and casualty insurers, who have an average liability duration of about 5.8 years, suddenly found themselves needing to improve their underwriting margins by 6 to 9 percentage points just to achieve normal returns. But look at life insurance down there. Their liabilities stretch out for nearly 11 years on average. Because life insurance is dominated by savings products and these long-dated, multi-year contracts with rigid guarantees, they were squeezed even harder by prolonged low or negative interest rates.
Which brings us to the most important question of this whole explainer. If traditional government and public corporate bonds are barely yielding anything, and you can only raise insurance premiums so much before customers just walk away, how do insurers actually survive an era of 0% yields? Well, they have to rebuild the engine.
And that is exactly what we're covering in Section 4, the search for yield, the rebuild.
We are now entering the world of private markets.
Insurers are transitioning their capital into highly specialized strategies to capture what's called an illiquidity premium. Basically, because these assets can't be bought and sold as easily as a standard public stock or bond, they pay you a higher yield for your trouble. Asset managers are increasingly using three main avenues for insurers: private asset-based finance, transitional commercial mortgage loans, and direct lending. Let's quickly demystify what this Wall Street jargon actually delivers.
Now, what's really interesting about this slide is exactly how much extra yield these private strategies generate compared to standard bonds. The boost is striking. Private asset-based finance delivers spreads of over 150 basis points, so 1.5% above comparably rated public corporate bonds. Transitional commercial mortgage loans, they offer the SOFR plus roughly 3 to 4%. And direct lending generates a massive SOFR plus 5.5%. I mean, that kind of serious income generation completely changes the math for an insurance company struggling in a low-rate environment.
Section 5. Optimizing capital efficiency. The upgrade.
So, surviving zero-yield environments isn't just about making money. It's about making money efficiently under really strict regulatory rules. Insurers are bound by capital requirements, often called risk-based capital. If an insurer buys a riskier asset, regulators force them to hold more backup capital, which hurts their overall efficiency. So the financial industry developed this incredible insider secret upgrade, the rated feeder structure. By pooling direct lending investments into a specific structured vehicle that receives an official credit rating, insurers can access that high-yielding direct lending we just talked about, but consume significantly less regulatory capital than if they just held the loans directly on their balance sheet. They are maximizing their yield per unit of regulatory capital. It's a seriously sophisticated structural upgrade to the engine.
So, the crucial point here is summed up perfectly by P. Jim. Public market bonds are necessary but insufficient in capital-constrained portfolios with yield targets. The old insurance engine powered solely by public bonds is effectively obsolete. To offer the products that we all rely on at prices we can actually afford, leaning into the complexity of private credit and advanced capital structuring isn't optional for insurers anymore. It is absolutely mandatory.
Which leaves us with this final, incredibly important thought to chew on. We've seen how the engine was broken by global macroeconomic forces, right? And we've seen how it's currently being rebuilt using these highly complex, illiquid private market assets. But as this multi-trillion-dollar industry becomes increasingly intertwined with private credit just to survive, how will this shifting landscape of hidden risks ultimately reshape the broader global economy? And, maybe most importantly for you and me, what is this going to mean for the future of our insurance premiums? It's a fascinating evolution, and for sure one we're going to keep our eyes on. Thanks so much for joining me for this explainer. Keep learning, and I'll catch you next time.